Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes coming to you live from Tampa, Florida. Once again, we're down for the ISCA regional swim meet for my 7 and 9-year-old daughters. It's been a full week, actually. They swim the prelims during the day, and then I go at night to watch them swim the finals, and my wife is an official, so it's been great. But I had a really unique opportunity. I ran into a bunch of interesting people down here. But first off, I had a chance to meet Bobby Fink at the meet. He swam in the St. Petersburg Club, won 2 gold medals. 800 is most famous. And I asked him when I met him, I said, what happened in that last lap? Because he went into that last lap of the 800 free in 4th place, and then he just turned into a monster and won the gold medal. I mean, he just came out of nowhere and he shifted gears and he just shot out of the gate. And he looked at me, I was like, what was your secret? How did you just turn it on? Is that something that you've practiced? Is that something you've thought about? And he looked at me like just complete deadpan. He goes, yeah, I've never swam a last lap that fast in my entire career. So it was just kind of one of those things. But what a great guy. Got pictures with the kids. Here's my little one, the 7-year-old Annabelle, picked up a medal last night. Mimi did as well. I don't have that uploaded yet. But it's been a great trip. And then on Tuesday night, our first night here, we were eating at Bella Vista or something like that in St. Petersburg, and for the team meeting, and I look across, and it's Kathy Wood of the ARK funds, the ARK ETF. She's got $52 billion across her funds. So I walk over and introduce myself. I thought she lived in California. She actually lives a town over from me in Connecticut. She was the nicest person you could ever meet. She was there with a friend, and so I'll meet her for coffee or something when we get back to Connecticut. But I think she's moving her firm down to Florida, which I can't blame her. That's amazing. But it's a lot of cool things happening in Tampa, that's for sure. But I still like Connecticut, and we'll kick off this theme for this week with this Warren Buffett quote. He says, "Long ago, Ben Graham taught me that price is what you pay, value is what you get. Whether we're talking about socks or stocks, I like buying quality merchandise when it's marked down." And that's really been the theme, and that's what we do, and that's our knitting. The question is, if that's so easy, if you just buy quality merchandise while it's marked down, why doesn't everyone do it? And the reason that everyone doesn't do it is because when you're buying things that quality things that are marked down, they don't often they take a little time to rebound and realize their full intrinsic value. And most people want to see profits overnight, and that's why they, over time, don't wind up doing as well as people that take a longer view and buy deep intrinsic value with a catalyst that can revert to its normal earnings power and cash flow trend over time, and that's where the opportunity is. So if it was easy, everyone would do it, and we just try to walk you through each week on how we think about things and how to get through those short-term periods when the intrinsic value is not being met, and then how we get to the other side of it. So we went through a few great examples last year. As a matter of fact, looks like Wells is back on fire this week after the jobs report, so we'll talk a little bit about that. But today I was on Yahoo Finance. I want to thank Sarah Smith and Ivana Freitas for having me on, with Kristen Myers and with Alexis Christoforous. And this was an interesting segment. I was on to talk about a number of things. First off was the non-farm payrolls report. The jobs report today blew the doors off. 943,000 versus 870,000 estimated. The unemployment rate fell to 5.4% from 5.9% versus estimated of 5.7%. Average hourly earnings did tick up 0.4%. So we are seeing it in wages. So we got to keep our eye on that as it relates to inflation. And the number of unemployed people went down from from 9.3 million to 8.7 million, which is a big improvement, albeit it's still much higher than pre-pandemic, which was 5.7 million. But how did the market respond? As you would expect, the market basically treasury yields increased up to 129 basis points. And just think, a few weeks ago it was just at 113 basis points. So they took off. Money came out of tech. Money went into the reopening trades, cyclicals, banks, energy, etc. And while we have this view over the next 3 to 5 years that's going to continue to be a great trade, I don't think that what happened today is a reason to dump out of everything else and just jump 100% back into banks and 100% back into energy exclusively. Obviously, we have our core positions across the board, but I think you're going to just see this back and forth. And then you have light summer volume on top of it. The biggest gains, obviously, were in leisure and hospitality, 380,000 jobs. 2/3 of those was restaurants and bars. Education was up 261, manufacturing up 27,000. And that's basically it. The stay-at-home trade was down. The cyclicals, the reopening was up. I think that's a knee-jerk reaction. I do think that there will be some pockets of value across different sectors that continue to do well. And if banks and energy continue to get bid, that would be great as well, because they have sold off. And we're going to be talking about, because a lot of people came into August and September really concerned, expecting a big crash. And what we're going to see is that we've already gotten those mini crashes in many sectors over the last handful of weeks to couple of months. While tech was going up, the rest of the market was crashing. And that was some of the reason that people were expecting a crash. They said, oh, weak breath, only a few stocks are going up. So we'll talk about that in this session. The other thing that I wanted to cover was, how do you deal with that? And I'm going to combine two. I was on the Clayman Countdown on Monday with Liz Clayman, and it was the same thing. First off, thanks to Liz and Ellie Terrett for having me on Monday. And it was the same type of question with the Stock Traders Almanac, indicating that August and September are weak for the last 33 years. By the way, if you look back over the last 90 years, when we were an agrarian economy, or more of an agrarian economy in the early part, actually August was a good month. But of late, obviously in an industrialized and information, August has been weaker. So what do? And I said, you use the dips to buy high quality stocks that have pulled back in recent weeks. And the 3 picks that we gave, which we also covered one of them on Yahoo today, was Citigroup trading at 0.87 times tangible book. That will normalize to 1 to 2 times tangible book as we continue to recover. It's trading at 8.5 times next year's earnings versus its historic multiple of 12 times. It's a turnaround story, as Jane Fraser has brought the efficiency ratio down from 64 down to 52.9 through cost cutting. Anything below 50 is great. And you're going to see more credit reserves released. That'll come back as earnings. And you're going to see commercial loan demand. We've started to see some anecdotal data that supports that, certainly in the second half of this year and the first quarter plus of next year. That's going to just skyrocket the commercial loan demand. And you get a 3% dividend yield while you're paid to wait. The second one I chose was Dollar Tree. And the reason I chose Dollar Tree, you saw in Amazon earnings, they missed the top line last week. And that's because people are getting back out and about. And I think the in-person retailers are starting to benefit from that. Dollar Tree is one that, again, high quality, that's pulled back a lot in the last couple of months as tech has outperformed, and trading at 14.5 times next year's earnings versus 18 times historic multiple. As I said, the online is slowing, so they should be a beneficiary. The average ticket was up 9.5% last quarter. They had the best same-store comp since 2017, up 4.7%. And why was the stock down? Because their guidance was light as a result of short-term spike in shipping and freight costs, which are going to go away over time. And as that normalizes, we're going to see this thing work back up and start to make new highs. Same with Citigroup. And then finally is Intel, trading at 11.8 times next year's earnings versus historically 15 times. It's got the lion's share of the PC and server processor markets. The server processor will be the main growth driver in the short term. Yields 2.5% while you wait. That Global Foundries deal would be revolutionary. It remains to be seen if that will actually get done. Thou dost protesteth, the CEO of Global Foundries, but it would become a behemoth if that did happen. That would certainly be a nice catalyst. If it doesn't happen, it's just at this point, quality merchandise marked down. You just got to wait through until it recovers and starts to make new highs. But I think over the next couple of years, this can be a $75 to $95 plus stock. So that's that. Then, so that was what was covered on Liz's show. On Yahoo, I had a bit more time. Had some things prepared with regard to earnings. If you look now, actually the estimates, we'll just jump ahead a little bit here actually. This just came in. Estimates for next year are now up to 218.04 from 217 and change last week. For 2022, for 2021, they jumped up to 200. No one would have believed that. The earnings growth is now 88.8%. If you remember, the estimates were 63%. I said we're going to come in well over 70%. Well, not only did we come over 70, we're coming in close to 90%. That's the good news. The bad news is everyone's going to use that to say peak growth. It's certainly going to be peak growth rate, but we're still going to grow. If you look at 2022 estimates, I think they're still too low. I do think those are going to work their way up to 230 plus and maybe even more. And then what that's going to do is going to take this forward multiple down from 21 times to 19 times. The market's going to look a lot more reasonable in the face of that. And the other thing that I had intended to cover on Yahoo, but they didn't have enough time in the segment, was that you have to keep in mind the consumer is in the best shape they've ever been. And this is a note from Bridgewater. Greg Jensen did it, co-CIO. I know him very well, great poker player. And they covered a bunch of things that were really valuable that I wanted to go through. First off, the consumer is doing better than ever. And that's been a result of shifting from exclusively monetary policy to adding a huge dollop serving of fiscal policy. And we're going to get another $4 trillion before the end of the year with reconciliation, whether they do this $1 trillion discrete deal or not. It's all going to get pushed through in reconciliation one way or another. And what you're seeing here in these charts by Bridgewater with Greg Jensen is if you look at household net worth as a percent of GDP, pre-pandemic, post-pandemic, it's up about 90%. So from 550% of GDP to 640%. But what's more interesting is the net worth of the bottom 60% by income is really accelerating at the fastest pace relative to income in recent history. It's completely shot up, and that's all the payouts, et cetera. And then finally, the savings rate was, give or take 8% pre-pandemic. It's now up at 20%. It's come off the boil a little bit, but 20% is still high. All that money is going to go back into the economy. And then household debt service, if you remember the last crisis, 2008, 2009, it was like 10.5% debt service as a percent of GDP. Now it's only 7.7%. We haven't seen these levels since the early 80s at the beginning of the last secular bull. So the consumer really couldn't be in better shape at this moment. Obviously, some people are still hurting from COVID. That'll get worked through as Powell keeps pedal to the metal to get full employment, has been his primary objective. But this consumer data was really interesting, and it does point to we're going to have to keep our eyes open for inflation, because you can't. You can get away with it with monetary policy if there's no velocity and it just pushes asset prices up. When you're putting it directly into people's hands And what few people are focused on, because a lot of people on Wall Street don't qualify for these checks, but the checks that they put out starting last month for the child credits, I think it's 200 to 250 to 350 per kid. That is much bigger than the extended unemployment that everyone was focused on that's rolling off in September. So you're taking away $300 a month, and now you're giving, if a family has 2 kids, I think it's like 250 to 350 per kid. So let's just say $500 to $700 per kid times 12. 7 times 12 is $8,400 a year. And people say, well, it's a tax rebate. But the problem is many of the people that qualify are under $50,000 a year and they don't pay taxes. So it's actually universal basic income. And the current administration has said that they want to keep this going through 2025. So when you're pushing that kind of money out, which is direct payment, I mean, it's going to lead to inflation that is likely not to be transitory if they really push everything through that they're planning on. So we'll keep our eyes on that, and that's why we do like the commodity plays over the next 3 to 5 years, even if any short-term weakness we get or catalyst we get is just an opportunity to buy for the long term. But these things seem like they want to get legs again, which would be really, really nice on top of it. But just the quantity of money they're pushing out there is starting to get really big. So that's that. Then on earlier in the week, for 2 days ago or something, the Robinhood, when Robinhood went up 24%, I said, it's interesting. I think it went up on Wednesday. I met Kathy Tuesday night. We didn't talk about Robinhood, but I saw the next morning that she had bought on the weakness. She bought in the 40s, and this thing shot up to like $85 once they saw. And I said, people are trying to jump on the back of Kathy Wood's vote of confidence in Robinhood shares. The catalyst was certainly Kathy Wood putting a sizable position after everyone was downbeat after the IPO. If you remember, it traded down 8% after the IPO, which I think it IPO'd at $34 or $38 or something like that. The other thing that happened that day when it took off, and this is the most important thing that I think many people are missing. Charlie Gasparino did touch on it on the Clayman Countdown that day. He was one of the few reporters to be on top of this. But options started trading that day, and there was a gamma squeeze. If you looked out, there were 70,000 contracts of, trying to remember, I think it was the $70 call option. So it basically controlled 7 million shares that the dealers sold, and they had to then buy the stock. And it turns out, and Lydia Moynihan in the New York Post got some short interest information from S3 that said there were like, and I'm cuffing this, but I think it was 28 million shares short or something. So it was a short squeeze and a gamma squeeze all in one. They just compressed time. They didn't screw around for months like they did with GameStop. They did it all in one day. And of course it rolled over. So we'll see how that plays out. But just to put it in perspective, I think it was trading at 43 times sales, trailing sales, relative to Schwab was trading at like 7 times sales. So, you have to take these things with a grain of salt. Structurally, the short-term supply and demand for the paper can go crazy, but intermediate to long-term, it reverts back to its intrinsic value, and we know that where that is, and it's let's just say we're not buyers of the stock. And then Megan Reid from CBC, I guess that's Canadian Broadcast Company, called me on the back of that Reuters article to go on her radio show, which I did. I don't have the clip for that, but it was basically the same facts I just shared with you. And then the other issue, 2 things I didn't have time to cover on Yahoo, but I wanted to just cover on this call, is in addition to the consumer, you have the Fed accommodative. So even after they start the taper, which I think will be after February of 2020, after the reappointment of Powell, you're still going to have massive liquidity. Even if they pare back, they're still adding every single month. If they go from 120 to 80 or 120 to 100 billion per month, and then rolling them over, et cetera. So the liquidity is still going to be massive. The fiscal stimulus is going to be unprecedented in human history. Liquidity is abundant, and the Fed balance sheet is still at all-time highs. And then lastly was the outlook. You had a lot of people looking for a seasonal crash and still doing so. The problem is that we've been having a lot of these flash crashes under the surface. If you look at materials, energy, banks, transports, industrials, the last couple of months have been weak, while a few stocks, the FANG basically has pushed the S&P up. But when you look at the small caps and the Dow, basically the reopening trade, Dow's done nothing for 4 months. It's traded sideways, and the Russell, the small cap, has done nothing for 6 months, half a year since February, and we'll look at that in further detail. I want to get to a couple of good Ask Me Anything questions from Greg Stewart. Asks, hey Tom, my question is, how do you determine when an option is at an unusually high or low price? This past VideoCast, you talked about your strategy for taking advantage of the recent drop in BABA. Even though you didn't know where the bottom was going to be, you noticed put options that were at an unusually high premium and that call prices were unusually low. So you sold some put options and used the money to buy even more call options. Your strategy makes a lot of sense. I just don't know how to tell when an option price represents a good opportunity. Maybe it's too complicated to explain, but if you can share how you know when an option price is unusually high or low, I'd find that really interesting, Greg. Great question. So I'm on this is a tool that anyone can use. It's optionseducation.org, and it's historical and implied volatility. So put in Dollar Tree, for instance. Now, as it relates to BABA on that day, what you basically saw was that it was panic and capitulation, and you can only really have a good feel for that through experiencing it over the years. But if I looked at the equivalent, the movement in the puts relative to the calls, it was like if a put moved $2.50, the equivalent call was moving like $1.50. So it's just like everyone wanted the umbrellas after it was already pouring. Everyone was racing to buy insurance after you had the earthquake. And I was willing to own more stock at 170 after it had fallen that far. So that's the simple answer. That was largely a feel and just looking at, because you really only had 30 minutes to get it done. That was the window of opportunity that was there, and you were either there or you weren't. But generally, when I'm just proactively looking for new things, what are some things I can look at? I can look at its current implied volatility versus its 30-day historic volatility. So if I look at the average, the 30-day historic volatility, when you pull this up, that's the blue line, versus its current implied volatility, that's the yellow line. If the stock is set up, the fundamentals are what I'm looking for, and the stock is trading down, it's where I want it to be, and the implied volatility, so it's probably been trading down or grinding sideways for a while where people have forgotten about it, and that implied volatility jumps below its historic volatility, I'm probably getting a decent price. As a general rule of thumb, I mean, if you can get long-dated premium for 20% implied volatility and you're 12 to 24 months out, you're usually going to make money as long as the business is decent. And at 20% implied volatility, my guess is it's a steady grower, and it's just out of favor, whether it's related to rates or time of year or a bad earnings report that means nothing. So those are some things. But the way you could, a simple way that you can do on a retail side is if it's meaningfully below its historic realized volatility in the short term and everything's set up, then you know you're getting a good price. Now, if you're doing a spread, it doesn't matter because you're going to offset paying too much on the leg you buy with selling high implied volatility on the leg you sell. So on spreads, it matters less. But if you're just buying long dated premium straight up, that's generally what you want to look for. Is it trading below its realized vol, current implied vol? So next, and I got to get through this because I got to get to the finals tonight. All right. So second question is from Tom. Thank you for this. Is from Kai Grodicki from Sweden. Thanks so much for what you're doing. Your way of reasoning, your thoughts every week has made me a better investor and learned so much more than reading a book or the news. Ray Dalio gave his thoughts on China, and I thought it was very helpful in addition to what you explained, maybe worth sharing. Thank you for doing that. And you can find this on LinkedIn. If you go to LinkedIn, Ray Dalio's profile, or just Google understanding China's recent moves in its capital markets. So Ray goes through this whole explanation, and no one knows China quite as well as Ray because Ray's been going there for 3 decades. A good chunk of his assets under management come from China. So he has a vested interest, obviously a huge reservoir of knowledge and experience and contacts. And he's basically saying, you know, they did this, maybe they should have explained it better. They didn't really mean it. And you should still invest in China because the growth story is unlike any other, is the basic summary. But read it. It was nice to see. And I'll leave it at that. But thank you for forwarding that, Kai. And then lastly, Sumit says, Sumit Kapoor, loved your trick of selling puts and using the premium to buy calls. I've used this strategy a couple times with some success, but I didn't think of using in this situation. Damn, an opportunity missed. A few questions regarding the strategy. How long did you buy the puts for and why? Also, you mentioned in your commentary, we also added some additional call premium, which I increased our notional exposure and lowered our effective basis. Did you mean you sold covered calls? If so, what was the duration of the calls and rationale? Thanks for all you do for us and have a great weekend. Best to meet. Okay, good question. So here's the general rule of thumb. When you sell premium, you want to sell short-dated premium, 30 or 60 days max, because you want time decay to work to your advantage. When you buy premium, you want to buy long-dated minimum, out, if you can do 12 months, it's always better to do 12 to 24 months. Otherwise, 3 to 6 months if you think the catalyst is imminent and it's going to turn, if you think it's going to take a month and a half for the move to happen, by 3 to 6 months. If you think it's going to take 3 months for the move to happen, by 6 to 12 months. And that's the way to think about it. So you sell short and you buy long is the general rule of thumb you want to be, because you want that time decay to work in your favor, not against you. Great question from Sumit. So moving right along, this was from Macro Charts again. I like his stuff. Everyone has a foot out the door. Option traders are again amongst the most negative in 30 years. Most signals led to market bottoms or rally extensions. This remains a wall of worry in full force for months, not even close to complacency. Follow the trend. So he just outlines options, flow oscillator, all exchanges, and then these green lines show what happened next. I always find his stuff pretty interesting. Next, the National Association of Active Investment Managers, they did push up. The reason I put this is because on the Wednesday article, it hasn't turned over. I think they report on Thursday. So managers are starting to chase as of yesterday. This is that BABA thing. It's trying to climb back here into this wedge. Now we'll see if it can break over this wedge. This was what we put out a couple weeks ago when we broke down, and we're going to see how this holds up. A lot of positive developments on that front, though. It's obviously had the heart attack. Now it's recovering. Question is, can it start to push higher? We saw earnings this week. Earnings were great. They were a little light, like Amazon on the top line, due to the retail. However, they increased their buyback from 10 billion to 15 billion, so by 50%. So they're going to be buying right along with you down at these levels to support the stock. That's very good to know. And the okay, so the revenue increased to 205 billion RMB from 153 billion. The analysts were expecting 209. That was the issue, why it was down a couple percent after earnings. And then the commerce revenue, though, was up 35% year on year. The active customers were up 45 million to about 1.18 billion annual active customers. And what else? Did this article not have? Okay. Oh yeah, here it is. The cloud computing, that what I've been bullish on is, and they have international business with, is their competitor to Amazon Web Services was up 29% year on year. That's growing super fast, and over the next 3 to 5 years could overtake AWS if they don't destroy, if the Chinese government does not put too strong a governor on them. So this thing is just a beast. Got curbed a little bit by government in the last few months, but I think if they just let them go about their business, this is going to continue to roar. And it's nice to see they're putting their money where their mouth is alongside us. Some unusual options activity, people buying calls out to January, 190 calls, 2,500 contracts. Business groups are now pushing Biden to restart the trade talks with China. That could thaw things. That would be very positive. That came out this morning at 9:32 a.m. China's harsh education crackdown sends parents and businesses scrambling. I told you this is exactly what was going to happen. The problem is, if you live in China and your kid doesn't get good grades, they wind up doing manual labor. And the last thing a parent wants their kids to do is grow up and work in a sweatshop. So, these tutors are absolutely essential. And now the government's getting pushed back for shutting or limiting these tutors because all these parents now have to pay double through the nose in the black market to find anyone who will privately tutor their kids so they get good grades, so they get good jobs, hopefully at a company like Alibaba. So short-term thinking, and maybe this thing gets reversed, who knows. But I thought that was funny, expected it, and funny. As China's recovery wobbles, why? Because they tightened too soon 6 to 9 months ago. We've covered this. They've started easing, and economists expect more policy easing, which will be a good thing globally and a good thing for China. Ray Dalio says China stocks still important part of portfolio after crackdown. That speaks to the article Kai sent us, Understanding China's Recent Moves in Capital Markets by Ray Dalio. You can Google it. And Chinese stocks jump as Beijing signals more economic support. So all that's good. Pfizer followed through. We've been talking about this stock forever from the low 30s. And then it finally broke out of its quote-unquote cup and handle. We think this can push up to the 50s over the next few months. But it's had a nice move here, so probably rests a little bit in here. And then here's the August CHOP stock market and sentiment results. So I covered in this article, I was on Fox Business on Friday and Monday. The Friday session we covered in last week's podcast, but we didn't cover in last week's article. And one of the stocks I covered, obviously I covered Novartis and Pfizer, which I had given originally in the mid to low 80s on Novartis and the mid to low 30s on Pfizer. And we feel those will continue to push higher over time. I also gave Cigna, and Cigna absolutely got decimated after earnings on this week. We had a modest size option, longer dated option position in the name. We added 50% to that position, and usually when they have a heart attack like this, so they beat on the top line and the bottom line, and they basically same thing as Dollar Tree. Dollar Tree had these short-term spike in costs related to freight, so they took their guidance down. Same thing with Cigna. They have the short-term costs related to short-term extra COVID costs. So, but their revenue continues to grow on the top line, beating expectations. So they have the short-term lowered guidance in earnings, and like people just puked out of this thing. So we added 25. So basically, we increased the position by 50, and we're willing to double it, but we didn't do it all at once. We're going to see, usually after the patient has a heart attack, it takes 3 days. If we miss an opportunity to add that last bit, the other 50% to double the position totally, we miss it. Not the end of the world, but I think we'll get an opportunity next week to top it up finally, and I think this stock works its way to new highs by early next year. And this is just a short-term overreaction to a high-quality company that's just a steady grower, right place, right time, and just creates an opportunity. So, but again, whether it's stocks or stocks, quality merchandise when it's marked down, except it usually when you're nearing the end of the markdown, you get a final capitulation flush, and that's what throws everyone out. And then it takes a little time to rebuild strength before the patient can be sent home from the ICU and from the emergency room. And then all of a sudden, you won't hear anything about it, but in the background, it just keeps climbing higher. No one's paying attention to it, and then when it breaks out to new highs, everyone will get excited about it again, and that's when you want to lay off the stock. So just wanted to address that. The Citigroup, Dollar Tree, and Intel we covered. And then here, one of the multiple indicators I look at on a regular basis is bullish percent. I do this across all sectors to give me a sense of where the opportunities lie. This indicator measures the percentage of stocks in a particular group or sector that are on a point and figure buy signal. I don't utilize point and figure charting, but I do find this barometer useful when it comes to finding the next sectors I'm going to focus on. So while it may feel like the market's, quote, due for a crash, there have been many, many crashes going on under the surface all summer long and creating opportunities to pick up stock on the cheap. We covered 6 above here. And looking sector by sector, here are some groups that are closer to probabilistic buy areas versus sell areas. So when I see these sectors, then I look stock by stock and I see. So you see utilities here, you see materials in particular got slammed. These are points you can chart up against it where if you were a buyer, you did extremely well. Again, the New York Stock Exchange, that's mostly like reopening and cyclicals. Transports have gotten hammered lately, like think airlines, think even cruise lines in it. Well, when FedEx and UPS have gotten hit lately. Some of the truckers, financials, the banks had that pullback that we'd been looking for and talked about that was going to come. It's come over the last couple of months. We think if you had to put new money here, we have a ton of exposure from last year at much lower levels, but new money, cities the most undervalued for new money today. And then energy is pulled back. So now we start to look to add back the 25% we shaved in June on weakness over the next weeks and months, and consumer discretionary, and then industrials you saw have taken this pullback. So if the market feels a bit heavy or your portfolio's plateaued in recent weeks, now you know why. Okay, a few stocks have pushed up the S&P, but look here at the small caps and the Dow, basically the reopening trade. Small caps have done absolutely zero since February, and the Dow's done absolutely zero since April. It's been in this sideways range, and now we're looking for it to, maybe it goes to the bottom of the range, I don't know, but ultimately work higher, break out to new highs, and push right along. The bearish sentiment on the AAII retail survey this week jumped from 24 to 31. Nice to see a little fear coming in. The fear and greed was down to 26. Probabilistically, it pays to be a buyer versus a seller at these levels between 0 and 25. You can see historically. And then this is the chart that we covered. The active managers jumped in this week. So we'll see there. But again, this is a stock picker's market. And there are major crashes, many stocks down 30% that you don't need to wait for the big storm to cast your net. Number one, the storm might not come. And number two, there have been many rolling flash storms already taking place in the last weeks and months. And if you wait too long to put out some lines in the water, you may find all the best fish are gone. That was our outlook for the week. As for earnings, we covered that. Estimates went up yet again this week. You can see here, and they keep moving in that direction. I think they're still too low for next year. I think this is going to work up to 230 and beyond. And then finally, key economic data this week. Manufacturing PMI came in strong. The ISM was a little bit weak, so those are mixed. Factory orders were up. That was good. This non-farm payroll ADP was really weak. And so people were expecting the jobs report to be mixed, and the jobs report blew the doors off. ISM non-manufacturing business activity was very strong. Now people are worried, will Delta slow down in August? Maybe a little, but I'm down here in Tampa. I mean, maybe nothing's ever slowed down in Florida, but restaurants are packed. Some people are wearing masks. That's nice to see, but it's not nice to see, but it's good that people are being somewhat cautious until Delta blows over. But I think we are getting close to that, 50-day mark, and hopefully in coming weeks that'll roll over before the fall. Or before school starts, and we'll put that behind us. Oil, let's see, we had a build of 3.6 million barrels, so keep an eye on that versus expected draw of 3 million barrels. And then continuing claims was good. That dropped down. That had been going up pretty much every week. That's a sign of health. And then finally this week we went over non-farm payrolls was 943 versus 870. And the unemployment rate dropped down, but wages ticked up a little bit. So those are sticky. We'll keep an eye on that. And consumer credit expanded, so the consumer's starting to borrow again. That's a sign of good spending to come and good health of the economy. So look, with that said, we went through a lot of things in a short period of time. It's the middle of the summer. Go out and have a great weekend. Until next week, make it a great one, and thanks for listening in. Bye for now.